Ciao guys, Cullen Gandy here and welcome to my channel where I talk about business, mortgage finance, personal finance, and just basically anything to get your life moving in the right direction. Today, I wanted to talk to those of you who are interested in becoming mortgage loan originators, whether you're switching from another career or just starting out in your career, and you're interested in seeing how that would work and what would really go into it. A mortgage loan originator, loan officer, or sometimes called MLO, is somebody who takes residential mortgage applications and negotiates terms and rates for those mortgages on behalf of lenders so that you can get a house that you probably wouldn't be able to get otherwise. This is a really cool job because you're helping get people into their homes, which obviously gives them shelter, but it's also giving them one of the best assets that they will have in their lives. So I really find a lot of gratification doing this for people. But to become a licensed mortgage loan originator, there are a certain amount of things that you have to do and standards that you have to meet in order to be hired as a mortgage loan originator in whatever state that you'd like to be licensed. So in this video, I'm going to tell you all about what you need to do as far as getting an education and passing whatever testing that you need for your licensure in order to get to that next level and become a mortgage loan originator. By the way guys, if you like videos like this, please go ahead and lightly caress the like button, hit that subscribe button and the notification bell so I can keep bringing you content just like this. Before you do anything and move to that next level as an MLO, you're going to have to take a 20-hour pre-licensing course that's approved by your state's regulator. These courses, which are approved by the SAFE Act, which we'll get to a little bit later on, usually consist of 3 hours of federal regulation and laws, 3 hours of ethics, 2 hours of what's called non-traditional mortgage education, and 12 hours of miscellaneous. And there's a lot of really good options to choose for when you're choosing a primary education course. Most people I know go the online route because they can sort of knock it out in as much or as little time as they want or need. Also, for certain states like Texas and a couple of others like Michigan and West Virginia, you're going to have extra hours of primary education to fulfill the requirements of those specific states. Now, after you finish your course material, you're going to have to go on to take the UST or the Uniform State Test that was created as a benchmark for knowledge for all MLOs across the country. And it's being adopted by more and more states every year. And it merits saying that after you do all of this, every year after, you're going to have to take 8 more hours per year of what's called continuing education, just so that you don't get lazy on everybody. So this test was created by the Secure and Fair Enforcement of Mortgage Licensing Act, or SAFE Act. It took together all of the knowledge that they knew about the mortgage industry and it standardized it for every state in the union. The SAFE Act also created the NMLS, or Nationwide Mortgage Licensing System, and that is where all of your licensing information is stored for different state regulators to access it. And this makes it a really streamlined process when you're trying to become a mortgage loan originator, especially in multiple different states. Now, to get to the crux of what I wanted to talk about, how to pass the mortgage licensing test and what you should expect to see when you're taking it to get the best leg up. Now, the test is divided into more or less 5 equal parts. You're going to have your federal regulations and laws, your general mortgage knowledge, your ethics, your MLO activities, and then finally, you're going to have your uniform state content. Now, during the rest of the video, I'm going to be giving you an idea of what you might expect to see as you're taking the test so that you can sort of put your mind in the right direction going in. Now, the first subject, federal mortgage related laws, is one that is very, very broad, and there's a lot of different stuff that's sort of thrown into this one subject. But the one thing that you should be mindful of is that there's going to be a lot of content geared around what you do on a day-to-day basis as an MLO. The first big law that you're going to want to know about is TILA, or the Truth in Lending Act. When you see anything regarding the Truth in Lending Act, you're going to know that, hey, this is something that governs how I am sort of advertising myself to clients and how I should sort of behave when I'm engaging clients for new business. So to give you an example, if someone posts an advertisement and say that they can guarantee somebody a rate and don't give them all the other information that has to do with the mortgage, like what your credit score is, what your personal number or unique identifier is, and all all of these other accompanying things like the APR or the annual percentage rate, then that would be a violation of TILA, and that's kind of a really, really big deal. The thing with TILA is that when you're in doubt, you always just want to disclose. Disclose, disclose, disclose. That means that you just want to tell the client, look, this is the truth of the matter, this is what I can offer you, and these are the conditions that I think that you would be able to qualify for whatever it is that you're applying for. That way, the borrower has a complete understanding of what they're going into when they're going into it. Now, there are a number of disclosures that go along with the transaction that have to do with TILA that I'm not going to list here, but you're going to want to know that, hey, look, TILA is a really important of your day-to-day activities as an MLO, and as such, you should really be aware of what TILA does and how it governs your business. Another major law that you're really going to want to be aware of, and one that you're going to see a lot on the test, is that of the Real Estate Settlement and Procedures Act, or RESPA. Now, you heard about TILA, that's called Regulation Z, but RESPA is Regulation X. Just that knowledge there is probably something that you're going to get a question about. Hey, what's Reg Z? What's Reg X? You know, these are just things that they throw in there to pad, I guess, the runtime of the test itself. You know, because you have 125 questions on the test, and of those, 115 are graded and 10 are ungraded. The Real Estate Settlement and Procedures Act is an act that governs how you initiate sort of a transaction with a potential borrower or client, and how you take that sort of client through the entire process of whether it be a refinance or a purchase transaction to its eventual conclusion at closing and funding. These two acts, RESPA and TILA, are going to have a whole set of disclosures that you're going to have to give out at the beginning and at the end of the transaction, called the TILA-RESPA integrated disclosures, because they're together. This is the very most important thing that I encounter during the course of my work as an MLO. Because if TRID has been triggered and if somebody's put in an application, it's now on me by penalty of law to have to do certain things. And so you're going to want to know what those things are. Getting back to what I was saying about RESPA and TILA, it's very important to understand for your business and for the test that when you receive that first application or 1003 document, you have within 3 business days, counting Saturday, but not Sunday or federal holidays, to send out your loan estimate document. This was created to give the customer timely notice of what their loan was going to cost them and for how long it was going to be paid. In the past, sometimes these loan originators wouldn't give their customers these loan estimates or good faith estimates for days or even weeks at a time. And so this was to cut back on the abuse of that power. So remember, 3 days after application, you're going to have to give them the loan estimate, but also 3 days before closing, you're going to have to give the initial closing disclosure. This is the disclosure that has all of the real costs and price of the loan as they would appear when they're balanced by a title company. So you can send as many loan estimate documents as you want to a client headed up to the closing, but you have to send your last loan estimate document at least 4 days before closing, because you have to send the closing disclosure, obviously, 3 days before closing as well. I guarantee you guys, this subject is going to be on the test in some way or form, so look out for it. Some other really important federal regulations that you're going to want to look over are things like the Dodd-Frank Act, which created the Consumer Financial Protection Bureau, which sort of regulates the mortgage and lending industry. ECOA, or the Equal Credit Opportunity Act. That's the act in government that gives everybody, each individual in the United States, the ability to apply for a loan and for credit. The Home Mortgage Disclosure Act, or HMDA, is one that sort of helps determine whether or not your lender is serving each of the communities in question in your area. And it's kind of a funny one, because if the person doesn't list what their ethnicity is, the HMDA Act sort of just makes the MLO guess as to what they think the ethnicity of the person is, which I always thought was kind of weird and crazy. But that did end up being on my test, so it could be on yours as well. And then there's things like the Gramm-Leach-Bliley Act, which is an act that governs how each of the mortgage loan originators and lenders handles and distributes or perhaps sells private information to consumers and what their rights are as far as that private information. It also governs how that information is stored and how it's eventually destroyed. One really interesting law is called the MARS rule, or the Mortgage Assistance and Relief Services, because a lot of people sort of try to commit fraud in that space of the economy. So this rule was created to sort of help consumers take back a little bit of that control. For example, you can't charge an upfront fee if you're advertising mortgage assistance or relief. You have to let the borrower know that at any time they could pull out of the deal, or that their lender may not agree to change the terms of their loan as a part of this relief. And then at the very end, you have to disclose, obviously, all of your costs and what they're going to be, and that it's contingent on whether or not you actually get them the relief that they need. Now, there are tons and tons of federal acts and regulations that govern what the mortgage industry does. The mortgage industry is one of the most heavily regulated industries in the economy. So definitely take a look at all of the different things that go into what a mortgage is and how it is governed. Also, for just general knowledge about federal regulations, you're going to want to know what the names of the different regulations are. For example, for ECOA, that's Reg B. For TILA, obviously that's Reg Z. For RESPA, that's Reg X, and so on and so forth. I will be going on to make really detailed individual videos on each of these regulations. So if you're interested in how these things work, go ahead and check those out in the future and watch out for those. The second major category that you're going to run into when you're taking the Uniform State Test is that of the general mortgage knowledge category. For this one, instead of understanding how each of these mortgages is regulated, you're going to want to actually know most of the products and what they do and who benefits from actually getting certain products and who doesn't. For example, you're going to want to know what a conventional mortgage is, how it works, if it's a fixed rate or if it's an adjustable rate mortgage. This has to do with all of the different types of mortgage products that you have. So you have the traditional, conventional fixed rate mortgage at 30 years. That's the big one, that's the big kahuna. But there's also different terms. You have the 15, 20, 25, 10 year, 30 year. You're going to have adjustable rate mortgages. That's where the rate changes over time and it's tied to a certain index. So that's definitely going to be on the test. So know about how adjustable rates work and how fixed rate mortgages work. You're going to want to know about mortgage offerings that are guaranteed by the government. For the VA loans, you're going to want to know what the down payment for a purchase is on that, which is technically zero, but does have a what's called funding fee of 2.3%. That's probably going to be on the test. For FHA, you're going to want to know that the minimum down payment for a purchase transaction is going to be 3.5%. That's super important. And you want to know that the USDA, which you think of beef when you think of the USDA, they also offer mortgages at 0% down if you live in certain rural areas that need some development. Bottom line is that you need to know how mortgages work and that there are a ton of different products to choose from, and just have a general idea of how each of them kind of functions in the economy there. For example, if you're buying a home on a 30-year fixed rate, you're going to want to know that generally people like to put down 20% on those so that they're not going to have to use PMI, or private mortgage insurance. Or if you're doing a refinance, you're going to want to know that, hey, you have 3 days after the end of closing to back out of the deal, basically, called the right of rescission. For every mortgage offering on a purchase transaction, you're usually going to find a mortgage offering in the refinance space. For the VA, you're going to have the IRRRL, which is a refinance that stands for interest rate reduction in residential loans for VA. Also, if you've bought a home with the FHA, you're going to want to know that there's a streamlined refinance for those type of loans. But overall, you're going to want to know that if it's a conventional loan, a lot of the impetus is going to be on you to get your terms and negotiate those depending on if you qualify. If it's a government loan, a lot of the impetus is going to be on the government to help guarantee that loan, where otherwise you may not have been able to qualify on your own. Now, the questions surrounding ethics on the test are some of the sneakiest questions in the entire test, because there's a lot of plausible deniability there. I'll give you an example. In the mortgage industry, we are not supposed to, as mortgage loan originators, give referral fees to people who send us business, especially realtors. Knowing that, the test sometimes is going to try to trick you by asking you a question that there's a lot of space for interpretation in there. I remember sort of getting a question that said, if you have a realtor friend and they send you business in March, and then 2 months down the road on their birthday, you buy them a meal or you send them a birthday card with a little bit of money in that, is that unethical or illegal? Because you're in your head about what is ethics and how does this apply to my business as a mortgage loan originator, actually think really rationally about it and know that, you know, if you have an inclination, it's usually going to be right. That is, in this instance, since you have a real estate agent that it happens to be your friend, it's not illegal or unethical to get them a gift on their birthday just because they sent you business a couple months earlier. So when you find yourself getting into the ethics questions on the Uniform State Test, you're going to want to do two things. Think critically, but also think reasonably and rationally. You're going to want to think, hey, what would a normal, moral, and ethical person do knowing how the mortgage industry sort of regulates you? And then go from there. The ethics portion is one of those things that is taken very seriously now in the mortgage industry because of all of the moral hazard that happened during the 2007 financial crisis. This was caused by no oversight over what the mortgage loan originators and lenders were doing and how they were doing it in conjunction with Fannie Mae and Freddie Mac. And because of this lack of oversight and ethics, this almost crippled the entire world economy. Now, the next and probably most specialized portion of this test has to do with mortgage loan origination activity. A lot of this has to do with what's called the math of the mortgage industry. So how to go about writing a loan, how to go about creating an amortization schedule, and sort of how that sort of interacts with each of your clients. For example, if you're offering a client what's called an adjustable rate mortgage, you want to know how an adjustable rate mortgage is sort of calculated. So on an adjustable rate mortgage, you should know that the mortgage is tied to an index in the market, let's say the Treasury market or the LIBOR, which is the London Interbank Offering Rate. And for that adjustable rate mortgage, there's a period where the rate is fixed and there's a period where the rate goes up and down depending on how that market is performing. So for an adjustable rate mortgage, you're going to want to know how to calculate how that changes and what the rates end up being over time. For fixed rate mortgages, it's much simpler. But then there's all the ideas around how you calculate the qualifications for a mortgage. If you're offering a 30-year fixed rate mortgage, you want to be able to tell the client, this is how much you will be paying over 30 years, and this is when your loan will expire. Now, when you're trying to qualify somebody for a mortgage, you're going to take different measures or indicators of whether or not that person is actually somebody who qualifies in the first place. The debt to income ratio gives you an idea of all of the certain liabilities and obligations that somebody has to pay over a month versus all of the streams of income that they get during the course of the month as well. You're also going to want to know how to calculate somebody's income in the first place because it's not always what it seems. When calculating somebody's income, if their income is calculated weekly, you're going to want to multiply their income by 52 and then divide it by 12. Some people think you should just take the whole salary and then divide it by 12, but you would actually get two very different numbers there. So you're going to want to know the individual ways of calculating somebody's income based on how their income comes in, whether it comes in weekly or bi-weekly or monthly or as just a lump salary. You're also going to want to understand what are all the things that you're going to need to provide for the borrower to be able to qualify if they're employed versus what they're going to need to provide you if they're self-employed, because those are two very different processes of how somebody is going to be able to qualify for a loan. If somebody is employed, you probably are going to want to know that they're going to need 2 months of the most recent pay stubs, right? And then 2 years of tax returns establishing that they've been employed and are gainfully employed probably in the future. For the self-employed borrower, we're probably going to need a little bit more information, such as the personal tax returns for 2 years going back, but also the business tax returns if they're a business owner, and an audited or signed year-to-date profit and loss statement. This is to ensure that there is a steadiness to the self-employed borrower's income that makes the lender comfortable with giving them a monthly obligation like this. If you're self-employed, and let's say the first year you made a lot of money, like $100,000, but the second year you made maybe $90,000, then the lender is going to take that $90,000 as a benchmark for qualifying you. If the first year you made $90,000 though, and then the second year you made $100,000, know that the lender is going to take the average between the two, so $95,000, in order to qualify you for whatever the loan is that you're trying to get. These are just some of the activities that you're going to want to know about when you're taking the test and when you're having questions about mortgage loan origination activities. And then the last subject that you're going to breach in this test is going to be the uniform state content. And I like to think of this as sort of the trivia of the test experience. And that's going to have to do everything with sort of trivial knowledge about certain parts of the federal experience, certain parts about mortgage origination activities, but all of this sort of surface level information that you're going to need to know when you're taking the test. For example, you're going to need to know how much money you need to pay if you violate TILA and RESPA in a certain amount of time, how much is each individual violation, what are the individual regulations called in the mortgage industry, and how do they interact with your mortgage loan origination activities. This was the part of the test that was meant to mix together and distribute to each of the states to make it a uniform process for them, right? So there's certain things that all states need to take into account when they are licensing mortgage loan originators, and you're going to find a mishmash of just about everything in this category. So, some things that may be important to know: who your state's regulator is, how long that you need to be holding on to advertisements. So for example, if you're doing an advertisement in 2015, you're going to want to know that you need to hold on to it until 2018. You're going to want to know things like the names of the forms that you have to give to people in order to get them into the mortgage process. Like what's an MU4, what's a 1003, what the names of different mortgage products are, what's a 1031 exchange, different little things about the mortgage industry that you may have to study about and may have to sort of pull out. Those are going to be in the uniform standard test. Now guys, when you're taking the test, it's very important, like any multiple choice test, that you use your very best deductive reasoning to get to the answer. Find out what the answer isn't. Because once you find out what the answer isn't, the right answer sort of starts to poke out at you. And if you really can't find what the answer is right away, the test does give you the ability to skip over it and go back to it. So you can sort of skip over it, and sometimes the next few questions will give you hints and clues about the question that you didn't understand in the first place. I can't tell you how many times during the course of the test that I was unsure about one of the questions and then went on and in the course of the next question it would tell me the process of how the first question was supposed to work. Use your deductive reasoning, figure out which of the answers is not the right answer so that the right one can sort of poke out at you, like I said. And then third, if you're not sure, don't be afraid to move on and go back to it later, because you're going to be able to get a little more context as you go through the test. And the main thing is just to not let the pressure get to you, because if you take the test and you don't pass with a 75, you can always take it again. In fact, you can take the next test 2 more times before there's a large waiting period of more than 6 months. Take your first failure, maybe your second failure, because more than I think 60% of the people who take the test usually don't pass, and bring that to your test that next time and pass it so you can start your mortgage career off on the right foot and get to that level financially and spiritually where you want to be for the rest of your life. The mortgage lending industry can be very stressful and it can be overly regulated at times, but it also is super rewarding, and it gives you the ability to sort of work remotely, be near the people that you love, and be able to have sort of a work-life balance that a lot of people don't enjoy, and a salary that can also be really, really good. And for a good mortgage loan originator and salesman, that can mean more than 6 figures, sometimes into the 200, 300, 400,000s a year. So keep your eye on the ball when you're taking the test, and I'll see you on the other side, guys. I hope you enjoyed this video. And like I said earlier, guys, if you like educational information like this, please go ahead and hit that like button for me, subscribe to the channel, and hit the notification bell so I can keep bringing you more content like this. Good luck at your test, and I look forward to seeing many of you guys in your future mortgage careers. Ciao, guys.